Hello, everyone, and thank you for attending today's webinar, Flexport Customs, Unlocking the Benefits of MPF Consolidation. My name is Andrew Phillips, and I'm a Senior Business Development Manager for our Customs team here at Flexport. Today, we'll be chatting about merchandise processing fee consolidation. But first, a few housekeeping notes. On your screen, you'll see a sidebar to the right of the main stage. If you have any technical issues and need assistance during the live webinar, please message us in the help chat located on the sidebar. In the menu above your screen, you have two tabs. In the first tab, you can register for Flexport's next Customs webinar, scheduled for August 14th. We'll be covering the first sale rule and how it impacts customers' valuation and duty calculations. In the second tab, there is a brief feedback survey for this webinar. We love your feedback, so please fill that out before exiting the webinar. At the end of the webinar, we will also be hosting a short Q&A session, so please add your questions to the Q&A function to the right of the screen. Your name and questions will not be visible to the audience. Finally, a brief legal note. Please keep in mind that all content provided in this webinar is informational only and may not be customized to your specific business requirements. We recommend reaching out to a Flexport expert to discuss specific dynamics affecting your individual business case. And joining me today is my colleague, Courtney Ozgunay, Global Customs Director of Business Development. Hi, Courtney.
Hi, Andrew. How are you?
Good.
Good. Thanks for webinar today. Thank you for everybody for joining. My name is Courtney Ozgunay. I am, as Andrew mentioned, the Customs Director for Business Development. I've been with Flexport for about 2 years, but about 20 plus years in industry. I'm a licensed customs broker and really been helping mitigate MPF for customers, importers large and small over the years. So really excited to help talk through it today and, hopefully drive some opportunity for everybody.
Perfect. Thank you. Let's jump into the agenda. So here is our agenda for today. We're going to cover a lot of ground. We'll start off with the basics. What is MPF? Who benefits? Some examples. And then we'll dive into risks, business rules, entry consolidation versus FTZ. And then we'll close it out by talking a little bit about Flexport's ACE analysis and taking some questions from the audience. With that, let's jump right in.
Right. So what is MPF? So pretty often when we talk about importing into the US, you hear the verbiage of duties and taxes. So duties, I think pretty much everybody's familiar with. That is the rate of tax that you pay for the goods that you're importing. It's tied to your tariff, your country of origin. It's usually a percentage tied to the value of the goods. MPF is merchandise processing fee. It's one of the two taxes that get assessed. So there's MPF and HMF. HMF is harbor maintenance fee, which is tied typically just to ocean imports, whereas MPF is applicable on most imports, regardless of that mode of transport. So it's calculated, it's a real fun number, it's 3.3464%, and it is calculated against the commercial value of your goods being imported as well. The regulations state that there's a minimum and a maximum for this, and these two I admittedly tend to forget, but I know the max right now is around 615. But unfortunately, it is increasing. It's tied to inflation. So as we've seen inflation grow, across the years, the rates of this go up as well. So it is increasing on October 1st. The max will be up to $634.62, as you guys can see. So MPF consolidation is what we do is you look at the way the regs are written, and it states that MPF is applicable when for the goods as they move on a single conveyance. So what we tend to do is if you've got lots of goods moving on a conveyance, and you can take where those would all max out on individual MPF levels, and you consolidate that into one larger entry, and that's how you can optimize on your savings on a larger import into the US. Right.
Yeah. One thing that I wanted to call out here at the beginning of the presentation is that, this program of consolidating entries into a single conveyance has a lot of different names. I've talked to a lot of customers, and I start to describe the program and how it works. And they say, my broker calls that vessel level clearance, or my broker calls that MPFM. And MPFM can stand for merchandise processing fee mitigation, merchandise processing fee management, entry consolidation. at the end of the day, they all mean the same thing. It's all about grouping multiple entries together to max out that MPF and save some money for customers. Each of these names is valid in its own way. Some of them can be a little bit confusing. MPFM is just another acronym. I'm not sure our industry needs more acronyms. Vessel level clearance. It's a little misleading because you can do it for air shipments as well. It's really not specific on mode, and I've seen it performed in both formats. But at the end of the day, it's super simple. It's grouping customs entries together and then moving forward to maximize that MPF fee. Next slide.
All right. So who can benefit from this duty mitigation or tax mitigation strategy? So biggest thing is right now, you actually have to be paying MPF. So there are imports, there's certain trade agreements, there are times when MPF is not applicable. Obviously, we can't save on money that we're not paying. So your present imports have to actually be paying MPF at this time. And what we were mentioning earlier, so moving multiple entries on a conveyance. So where you've got lots of imports coming in potentially on one plane or on one vessel, where those individual entries would max out that tax. When we have that happening, what we can do is take those and converge them into one entry. And then that way, that larger consolidated entry maxes out at the tax the one time, as opposed to having multiple entries maxing out at the tax. And to max out, obviously, then sort of obvious as well is that the combined value of these goods must meet that threshold. So it's a very low value shipment. You're not going to meet the max, and therefore consolidating it isn't going to allow you to optimize on savings because you're not going to have maxed out that tax threshold. And then another thing we'd like to call out too is that we know importers will use more than one broker. You could have multiple shipments coming in on one vessel hitting the same time in the same entry port, but if you've got different brokers clearing it, you're not going to be able to take advantage of this. So when we look at how we route cargo or who's clearing that cargo, if you are trying to optimize these savings, having those entries go into the same port of entry with the same broker will allow you to take advantage of the solution more often than not. All right, I think Andrew's going to go through an example now for us.
Yeah, absolutely. I think talking about it is great, but seeing a visualization here is super helpful. So we've got a fictional apparel account here, $100,000 in shirts, you would pay $346.40 in MPF. If you've got $200,000 in pants, you would hit the maximum and you'd pay $614.35. If you also have $150,000 of shoes, you'd pay $519. And the whole point here is that one of those entries is already maxed out. If you group these together on the next slide, you'll see that the shirts and the shoes essentially come in for free for the MPF piece. So in this specific scenario, you can save $856 in MPF. Put that contextually, it's probably more than you're paying your broker to file those entries. And this program is, broker driven. It's work that your broker is putting in to consolidate these entries for you. So great example, super simple.
We typically see those thresholds really applicable in the space of retail, and then tech, the higher technology imports, pharma, any of those things that have a little bit higher of an entered value, they're going to max out on those entries, and we're going to have a lot of opportunity to see if we can do some groupings.
Yeah. The larger the company, the larger the scale, so the larger potential savings. So if you're importing tens of thousands of entries and consolidating, then obviously the bigger savings potential. You've got 100 entries on a vessel versus 5 entries. But even 2 or 3 entries combined together can add up to substantial savings for an importer.
Yeah, we know lots of customs and compliance teams at importers tend to be seen as just an expense and causing problems and costing money as opposed to yielding revenue. So anything we can do to help get some savings in there, you do some expense mitigation, we know is always well received. So I always like to try to look at that as well. All right, so this seems great. What are the potential risks? What do we have to be concerned about? So the potential risk is really around when you take these groupings and you take, let's say there's 10 entries. If those are 10 specific containers, if one of those gets flagged for an exam, you could potentially have all 10 of them sitting for an exam. Obviously, we all know that gets very expensive. Container sitting in a port, pending an exam from customs, having to go through all that can obviously incur some additional expense. So what we try to do in that space is take a look at your historical exam rate. So if you typically as an importer are not seeing a high level of exams, then we really wouldn't be too concerned that all of a sudden this would get stuck or caught or held up by customs. If you know perhaps there's one specific product that does typically get held by, either customs or a PGA, we would actually just want to omit that specific product. So if you know that one of your types of tiles always gets held for some reason or potentially tied to the country of origin, we just would not group that specific item in the entry and then leave that one out and then group everything else. And then the other piece too is if you're using multiple freight forwarders, multiple brokers, if we're doing a dock turnover situation, right, where the broker's getting notified closer to the time of entry, there's a chance that that dock turnover, that notification of a shipment might get actually submit to the broker after the entry has already been filed, so potentially could miss out on opportunity. And the way we tend to do these entries is by grouping at that entry summary or your 7501 level. We really like to have everything prepped further upstream. We like to review all the data, the commercial invoices, product mix, those entry ports, and make sure that everything is tracking to a specific entry port, that we can group it as high level as possible. And then again, omit anything potentially for a flag, and then submit it all at that entry summary level to make sure that we are getting all of your goods cleared on time, the duties paid, and then hopefully maxing out that tax to the best of our ability. We feel that that's the most compliant way to move forward with this process.
Perfect.
Oh, we can talk some more about these business rules too.
Yep, absolutely. When you talk about the risks, there have to be mitigating factors, right? What can you do to avoid some of the risks? And the simple rule of thumb is you can create some business rules based off your risk tolerance with your customs broker. So, if you've got a simple commodity set, few SKUs, few classifications, super low exam rates, you might be more willing to have high amounts of entries grouped together. Some clients I've seen, they only want 50 containers maximum grouped together because they don't want too much of their freight potentially held and at risk of storage if there is an exam. I've got other clients that say, no holds bar, let's just open the floodgates, and I know I've got low exam rates. I know that my broker is capable of managing exams quickly, and they feel like there's low risk, and they want to get every dollar out of an MPF entry consolidation program as possible. So identifying those specific products and understanding a client's risk tolerance is super important. And then once we do understand the risk tolerance, we can build those business rules of don't max out, don't do more than a certain number of containers. Make sure that you also save a minimum amount of money. It might not make sense to group 50 containers together to save $10. Right? So maybe make that minimum threshold in savings $50 or $100 or $150 so that you can balance the risk versus reward in an MPF entries consolidation program. So all of that can be done by a simple exercise of reviewing risk tolerance and preferences with the broker. They decide those business rules and implement them for you when they set the program up.
Yeah. And these are also flexible. These are not things that, we build them out once and they can never be adjusted or amended. These are absolutely things that can be very fluid, part of the SOP. So if you start seeing a specific product starting to get flagged, then we go ahead and remove those from consolidations. We don't continue to loop those in if we don't, if they're not yielding any value. So these can be very flexible as we go through, as we're doing entries, and can be reassessed every 6 months, every 12 months. And additionally, this is something too that should be looked at potentially in conjunction with the transportation side of the business, because, I know some companies don't want more than X amount of containers on a specific bill of lading for, potential loss of or insurance, should there be an issue with the vessel or loss of goods at sea. So absolutely taking a look at what the current thresholds are for your business moving the cargo physically. And then also routings. So I see sometimes where you've got some of those ports that are really close together, the routing of that string will call on, let's say, New York or New Jersey, or then it'll hit Charleston, Savannah. Well, if you're trying to optimize those clearances, we want to ensure that the goods are actually discharged at that same entry port, because you'd hate to have a few get off in Charleston and a few get off at Savannah. If there's no necessarily, business impact to those different ports, then you would want to have them all discharged at the same port and then group them in on that same entry. So, because it is tied to the port of entry for the clearance. So again, it's just something that we can look at with the data and take, see what we're finding as far as routings, volumes, and those thresholds. and then just tie the business rules to it. All right, so I feel like this is the big one because this is always what we get asked is, hey, I've heard I can save so much money using a free trade zone. What do you guys know about free trade zones? And then, or why would I do MPF and not a free trade zone? Sort of what's the comparison? So I really tend to think, and this is sort of my personal opinion slash educated opinion, that unless an importer is doing, physical transformation where you're importing parts and producing a different product in the zone and then, pulling that zone out, and that's where you're going to save on your actual duties as well. We see that really often in the auto industry. They import parts, they create a vehicle, and then the vehicle is actually what's withdrawn from the zone. Or you're saving just tremendous amounts of money, $200,000 to $300,000 a year. I don't actually see the FTZ as being a huge benefit to our importers. It comes with a ton of overhead. You'll see on the right of that screen that we've got, you actually have to have the physical investment in a warehouse. You need to have all the approvals and the setup and the regulatory oversight from customs. You're likely going to need to invest in inventory management. That there are providers out there that'll do it, but obviously that's an extra expense. Potentially headcount as well to manage, the zone operation. You are saving MPF for a week and it can help improve cash flow. But again, it comes with a lot of expense and management tied to it. So if we're not saving a lot of money, it's really going to negate any savings on those taxes because you're going to have to pay for the operation of the zone. Whereas with the MPF consolidation, you heard how this works as far as taking a look at your entries and your business rules, but there's no physical investment. It's something that your broker can turn on and start handling as far as their entry operation. We don't need to get approvals from customs. It's something that can get set up relatively quickly with your broker. There's no additional software, and it allows you to save MPF at the given conveyance. So to me, it's a much easier way to get essentially the same savings. I know there's importers that do set up a zone just to save on taxes of this MPF tax, and it's again comes with a hefty investment as well. So I really try to look at those two different scenarios and make sure that the savings would benefit the expense tied to the zone.
Absolutely, yeah. I've seen importers do the initial analysis expecting, an FTZ because you can do that weekly consolidation, pay the max MPF for all the imports that came into a week versus on a single conveyance. But then, the lease on their warehouse goes up next year and then it's no longer profitable and they've got to get rid of an FTZ. And they've spent years setting this up with customs and that cost can really change over time. Whereas MPF is kind of low risk. You can turn it off at any point. You can turn it on very quickly without the heavy investment needed up front.
Yeah. And I know Andrew and I have both been in the industry for enough time, worked with lots of the larger importers who would benefit from an FTZ because they are moving that much volume. And I've even worked with several that have actually invested, gone through the whole zone route, set it up, and decided after a few years it wasn't worth it and reverted back to just doing more of the MPF consolidations. So it's not atypical to just really just decide that FTZ work is not really going to be driving the value that it seems upfront initially.
I think another good point is that you can do both. You can have an FTZ, but it is port specific, right? And so if you've got an FTZ in LA, but you also have multiple entries coming in on multiple conveyances into New York, you can do an FTZ in LA and you can do MPF consolidation in New York. So I think that's also a really nice piece to call out is that it's not a physical piece of infrastructure that you need to invest in. It's the way you file your paperwork that's different. So that's another big call.
That makes sense too. Definitely seen importers that'll use a zone for one or two larger import spaces and then use MPF consolidation in some of their other ports, or if they've got shifts of volume. As we know, every now and then everything goes all water and then it goes back to LA. And so when you're kind of rerouting cargo like that, sometimes it makes sense just to look at some additional solutions. And the other piece I want to call out, because I do feel like we tend to lean in on the ocean space when it comes to MPF, just because there's larger amounts of volume. But we are also able to do what's sort of called a cross-dock FTZ. So if you've got a warehouse, which Flexport has several warehouses at this point that are set up as free trade zones, we're able to, basically do that entry to get it into the zone and take it right back out and just, have it move across a warehouse to save on that MPF tax. And it's another way to do it when you've got air freight, which is potentially smaller volume than several ocean containers.
That's great. Cool. So the next thing that I wanted to talk about is Flexport's ACE analysis. I'm going to start by just describing what is ACE off the bat. So ACE stands for the Automated Commercial Environment. It's a customs system that you can get access to your import records going back 5 years plus year to date. So it's August. You can go back 5 years plus 8 months essentially and see your past transactions and your customs data. Everybody that's ever worked in ACE knows that the system isn't the most user-friendly. It can be difficult, and you've got to really learn how to run reporting in there and get access to it. There's the new ACE, and then there's legacy ACE, et cetera. And so we got a lot of feedback from clients that they wanted help with navigating ACE and analyzing that data. And so Flexport built an in-house software that does that for clients. And I wanted to call out here on today's webinar, anybody attending can have a free ACE analysis with Flexport. If you want to do that, reach out to customsbd@flexport.com. That'll come to myself and Courtney and team, and we'll reach out and schedule and walk through the process of getting it set up. Some importers have to apply to get access to ACE. If you already have ACE, you can also share cross-account access with Flexport. And we pull a number of reports with 3 primary objectives. The first one is we're going to show you some statistical reporting. We're going to show you your entries, how they've changed over the years, what have your duty rates looked like. We're going to tell you your main ports of entry, your types of entries. Are they quota? Are they standard consumption? Do you have anti-dumping, et cetera? The second thing we look at is any kinds of compliance risks that we can identify. And the primary way that we do that is looking at inconsistencies in the way that entries are filed. So we see you're importing from the same manufacturer, from the same country of origin, but sometimes you're claiming a free trade agreement, sometimes you're not claiming a free trade agreement, or something along those lines where the same HTS code is coming in and it's not declared the same way. Sometimes you're saying you're related to this party, sometimes you're not saying you're related to this party, et cetera. And we call those out. The third thing, and probably the most important thing that we do in an ACE analysis, is we look for duty mitigation strategies. And MPF is a standard data set that comes back. On this example here, you can see, what is this, a few $100,000 in potential savings for this fictional client, where if they group multiple entries together, we've got examples of how many entries came in on a specific vessel, what they can save at that individual vessel. And you can look back and size up, hey, if I was going to implement MPF, what would this save me? And Flexport can do this for any client that we're currently filing entries for through our ACE account, or we can do it for any client that wants to do it, or any prospective client that wants to do it if they want to share cross-account access. So huge benefit here. The fact that we're doing it for free, we really just want to demonstrate our expertise and help importers in the industry. So I would definitely recommend taking us up on that offer.
It's a really great tool. And even it's just a really great audit as well of your import program. So even if we don't find anything or everything is really clean as far as the data, you've still got that, that audit information. Should customs come ask, you can prove, hey, this is our history. This is how compliant we are. It's just a really good, additional component to an importer audit program. So it's really great, and would love to help more importers take advantage of this data. All right. So quick recap. Just go through our examples as far as the cost savings. If an importer has 5 house bills with commercial values $50K each, and they're on 5 different entries, which is the scenario we've been talking about, the importer would pay $866 in MPF. However, if there's 5 house bills, we consolidate it into the one entry, then we would we would pay just that max of the $614 and save the balance of that tax. It's a relatively low lift for the importer. It's something that I would recommend talking with your current broker, going through the business rules, making sure everything is in place to start doing these. We can, and basically turn on this solution relatively easy and start reporting back on how much savings we've yielded for the importer. And there's no implementation costs. So we mentioned FTZs can be very expensive. They require a lot of maintenance, a lot of overhead. For an MPF consolidation program, there is no implementation cost. The broker is going to basically look at your sailing schedules, your volumes, your ports of entry, and start building out those business roles, and then can start doing entry consolidations. Once they get close enough to arrival, start doing those groupings and do those entry consolidations. So for us, we think it's the easier way to set it up, lower costs, and still save some money for the importer.
Perfect.
I think that's it.
Yep. At this point, we're going to open it up to Q&A. Feel free to put your questions into the Q&A section on the right of the screen. We will be keeping those questions anonymous, so you don't have to worry about us outing anybody in this platform. So feel free to ask those questions, and we can start taking them from there. Perfect. Looks like we've got, yeah. Courtney, you want to take the first one, or?
Sure. So, Andrew, question for you, since I know you help our importers with ACE analysis all day, every day. What type of savings have you seen in some of the ACE analyses that you have done? What are your typical findings? What have you discovered by looking at an importer's data?
Yeah, I've seen huge ranges in findings from compliance risks to duty savings, but if you're going to try to calculate like dollar amount, I think probably the biggest I found for a largest importer is right around $10 million. Those are found in a couple of categories. It's MPF savings, it's first sale, it's duty drawback, missed 301 exclusions, etc., are some of the bigger ones. But I know that in the history of Flexport running ACE analysis, we try to track, what's with a ballpark number that we've identified for clients. And I know that we're over 500 million in that category. So huge savings potential. We've done hundreds of these analysis, and to be able to find that much money is really quite impressive in my opinion.
I agree. It's really fun to go and show importers, hey, look what we can change a couple of things and save some money and optimize a solution for you. All right. Are there other ways to mitigate duties for an importer of record? So outside of just an MPF consolidation, obviously that is saving on the MPF tax specifically. There's actually lots of ways that we can look at trying to mitigate some of the duties and taxes that an importer pays. Obviously, there's first sale programs. Drawback is a huge one. So if you're importing and then doing exports as well, we should absolutely take a look at and see if there's a potential for drawback. We have lots of importers that don't realize they could claim drawback on either goods that they have to destroy, or if they send out a different type of good, it can do the like item drawback. So drawback is really an underutilized program within the world of U.S. imports, and there's lots of ways we can look at saving money there. Our drawback team is fantastic, and they also have a seminar coming up. I think our next one is first sales. We mentioned at the top of the session, but we're going to have one for drawback as well. And anybody that's registered here is going to obviously get those invites for the additional ones also, if there's any other seminars that are of interest to you. Andrew, any other thoughts on duty mitigation strategies?
No, I think there's plenty of them. I know that we've got a bunch of webinars that are kind of focused around duty mitigation for clients that are coming out. So stay tuned. If you join this webinar, you'll get kind of publications and reminders of those coming out in the future. So I think we've got that piece covered.
Yeah, and in addition to our standard brokerage offering at Flexport, we do have a team that's dedicated solely to duty drawback, and we've got a team that's dedicated to the trade advisory space, so classifications, post-summary corrections, for any of those exclusions tied to 301s, just helping with an import audit. So there's a whole team that's able to help if you've got stuff that's not your standard brokerage, but it's in more of that consulting space. So we're happy to support if you ever have any questions.
Great. Courtney, looks like we've got another question here where it says, what is defined as commercial value? Do you want to take that one?
Yeah. So MPF is based on commercial value. So that is the entered value that's on your commercial invoice. So the regs go into lots of ways of how valuation is termed. Very base level, it is the price payer payable for the good. So if you paid a factory 5 cents to create a pencil for you, it would be 5 cents times however many pencils. And that's very basic. There's ways that if you'd given them a mold, you'd have to do
Assist.
An assist. Thank you. What's the assessment? Wrong word. Do an assist. So there's ways that the valuation can change. It's tied to your Incoterms, but your most base definition of entered value per the U.S. government is your price paid or payable for that item.
Right. Courtney, I think I'm going to take this next question. Someone asked, what is the value threshold for MPF? So to hit the minimum MPF, it's $9,143 in entered value. So anything below that will hit the minimum. And then to hit the maximum, it's $1,777 and $177,353,000. They're not round numbers because they keep going up and changing based off inflation. But essentially, if you're importing $177,000 worth of good across multiple entries in a single conveyance and you group them together, you'll start to see a savings.
Awesome. All right. Can you do this program with multiple vendors? Yes, you absolutely can. If you've got multiple vendors that are shipping on, if they all end up on, the Maersk Tokyo, you've got 5 containers. It's really at the importer level. So it doesn't matter if there's multiple vendors. If you do a consolidated you just need multiple containers that are all going to max out, because an LCL shipment, sorry, I was talking through this one, but obviously, unless there's multiple LCL shipments at the entry level, different house bills, you would want to consolidate those, but it doesn't matter on the entry piece how many vendors are involved. It's all tied to that port of entry and then the importer of record. And again, sorry, at the same broker level. We can't split it out across brokers.
The next question is, what is the best way to handle broker impact, as they will be losing revenue by processing and billing fewer entries? Courtney, do you want to?
I appreciate this question. Yeah, thank you. We actually typically, when we price this, we would still do that entry level processing, and then we take it and do that one large grouped entry, and then that's what yields the savings. So the broker fees are typically still the same, that they're all billed out at the standard entry level rate. We wouldn't move to doing a one consolidated entry fee, because obviously your broker is still doing all of that entry level work. We also want to ensure that you can still get all your reporting that you're used to with Flexport at the SKU level, entry level. You still want to have that granularity. So we wouldn't want to end up with one big, large consolidated entry. So still do the entry work at that same entry level, and then we take all of those entries that are applicable for consolidated entry, and we group those and submit those at one time to customs to get that tax maxed out.
Yeah, and I think on top of that, it is very common for a broker to charge a percentage of what's recovered through an MPF program. It aligns interest with the broker to try and maximize the potential savings for importers. So they still charge, if they had 5 entries, they're still going to charge 5 entries. They're not going to charge 6 because they grouped it into a new one. They charge the 5 entries that would have been there, and then they generally charge a percentage of what's recovered.
Recovery, yeah, absolutely. Andrew, one for you. What is the percent fee for MPF?
Yeah, just looks like someone missed writing this one down. It's 0.3464% of the commercial entered value. So 0.3464.
We will also, these slides in this deck and all that will be sent out. So if you did miss writing any of these notes down, you'll get the details tomorrow, I believe. All right.
I'll take this next one. So it says,
okay.
Can this be done for LCL shipments? We sometimes have multiple LCL shipments in different containers on the same vessel discharging at the same port. And the answer is yes. You can, as long as they're hitting that threshold where you can max out MPF in value, you can definitely consolidate LCL entries into a single customs conveyance. It's really just changing the paperwork, right? So it's not a big deal. As long as you're hitting that threshold, you can still benefit.
Yeah, if you've got multiple LCLs that would be, that are, let's say 5 different house bills, which would yield 5 different entries, we can group those. If you've got multiple LCLs that are turning into like one full consolidation box, that would probably, I'm assuming, be one entry. So that one wouldn't have any opportunity. But if you've got a vessel that's got a couple of different LCLs on it, then this would still be applicable. All right, Andrew, a good one for you. Where can I see my ACE number? And is this something we should have, or the account numbers based on number of brokers importing for us?
Yeah, so to get access to ACE, you have to fill out an ACE privilege application. So you submit it to customs, you fill out a form, they time that form, they say it's roughly 10 minutes to fill out, and you send it to them in an email. They then assign a top account owner and they give you a username and profile. So each user within a company has a unique username and profile, and then there's a top account owner within an organization. If anybody needs help, learning how to apply for ACE, that's something that Flexport helps many importers do. So feel free to reach out and we can walk you through it. We've got a quick one page document on how to do it.
Yeah, the ACE portal has its fair share of challenges. So if anybody gets stuck, don't worry, you're in good company. We'll happily help navigate it with you. All right. So can this be useful for a smaller company doing around 300 shipments per year? I would say really we should take a look at the ACE analysis, because what we'd want to do is just take a look at what the entered values are, because if those are, it's really going to be more impacted by the frequency of shipping and the entered value of those shipments. If you're doing 300 and you're only doing 2 shipments a week and they're coming in at different times, they're not really going to end up hitting anything. But if we've got those shipments coming in at the same time, hitting that same port of entry, and they're maxing out that threshold, then there might be some opportunity. But we can tell that pretty easily with an ACE analysis overview.
I'm going to take this next one, Courtney. It says, okay, can multiple entries on a vessel be grouped if the containers have different inland destinations? I think the quick call out here is, if they're being cleared at the port of unlading. So if you've got, 20 containers on 15 entries that are going to arrive into LA, and then some of them are going to go to Las Vegas, some of them are going to go inland, some of them are going to go up, to maybe they're going to get on the rail and go to Chicago. As long as they're manifested to clear at the port of LA in that same port, they can still be consolidated and filed into a single entry. So, as long as your clearance port is the same, you don't have a problem. If you've got a bunch of containers that are going into LA, and then 10 of those containers are moving inbound up to Chicago and clearing in Chicago, then they'd have to be on the same train to be able to be cleared together and save MPF. So you got to look at the specific scenarios there, but generally it's based off of the port of clearance as to how you can determine if you can consolidate.
Yeah, and that's where we were mentioning too. Sometimes this exercise is great to include the transportation team in it as well, because maybe they don't realize that by having those goods move, with that final destination of inland, therefore there's an IT that's potentially changing your opportunity to do some of these consolidations. So looking at the overall flows of cargo can help with this exercise as well. All right, I can grab this next one. Can I save MPF if I only import on a single HTS from Mexico? Potentially. So MPF is calculated at the entered value of the shipment. It's not tied to the country of origin or the single tariff, any of that. If you're importing that same product, it's really going to be, does that product and that country of origin pairing have MPF tied to it, right? It's not falling under a free trade agreement. I don't know if this specific item is under USMCA. So therefore, when, potentially if there's a free trade agreement, it might not have the tax tied to it. So we'd have to make sure that the tax is actually being paid and that those entries are maxing out on that entered value. So if there's a free trade agreement in place, or the value of the goods isn't high enough, it wouldn't optimize, but it's not specific to a single tariff or a single country of origin.
Yeah, I think it's also important to call out, like, how are they moving from Mexico to the US? Sure. Are they coming on a single truck? Like, you can't group, multiple trucks together, right? So that might be a limiting factor there, but we'd be happy to meet with whoever's asking that question and help them with it.
Yeah, absolutely.
Okay. Then let's see. We're going to do, is there an MPF drawback opportunity is the next question. So I believe this is asking about a duty drawback, right? So this is the thing that Courtney mentioned earlier. If you're importing a product and then you take that product out of the US economy, say you do that via destruction or exportation, then customs allows you to recover the duties, taxes, and fees, 99% of them for those that were paid. So you can recover the standard duty, Section 301 duty, merchandise processing fee, and harbor maintenance fee via a duty drawback program. You don't get 100% of it back because customs keeps 1%, but it can be recovered as well. So if you want to explore drawback, definitely let us know. We've got a team that specializes in that.
And it looks like we've got two questions that I think we're going to take offline and we will circle back. One of them is around doing post-entry when you've got a consolidation in it. And then another one is really specific to drawback, which is a little bit out of scope for this specific seminar, but we'll gladly reach out to you guys offline and get you updates about that one, just so you guys know. We've got one question that just popped in. We do exports and our import experience is not yet built for imports coming from different vendors, i.e. from China or Turkey, that may have different arrival timeframes. Is it possible to consolidate some as one entry and use the MPF program? So if they're coming in at different arrival timeframes, it's not going to be applicable because they do need to, arrive in on that same vessel, that same entry port, and then, be cleared by the same importer of record. So if you ended up with cargo from these two different origins that are on that same vessel and hitting, New York or Savannah at the same time, then absolutely we can look at consolidating those. But if one of them's arriving on the 12th, the other one's arriving on the 20th, they're not going to be able to be submit as being into that same conveyance of a vessel. So it really, those are sort of your very base criteria, is that it's on that same vessel, which then yield your conveyance per the regs, same time of entry, same port of entry, and then same importer of record. Really beyond that, it's going to get into business rule and nuance, but it does need to hit those couple of criteria to be optimized into one entry.
Great. Well, Courtney, I think
that's it.
Yeah, I think that's going to conclude today's webinar. First off, I want to thank everybody in attendance. If you'd like to reach out to our customs team, explore any of these topics in further depth, feel free to reach out to customsbd@flexport.com. And then one last reminder, before you do exit, please feel free to fill out the feedback survey before exiting. We love to get that feedback and definitely try to improve our webinars over time. So feel free to do that and let us know what your thoughts were.
Yeah, appreciate everybody's attendance today. Thank you.
Yep, thank you.